Hi, I'm David Libman. Today I'm going to walk you through the Investment Primer Part 2. The first thing we're going to look at are important terms. We're going to start with recourse, then look at the debt service coverage ratio, DSCR, and finally we're going to take a look at the cap rate or capitalization rate. Recourse. So what is recourse? Recourse means that if there's any trouble with a loan, what can the lender do to try to recoup their money? So with a non-recourse property, the lender cannot do anything except go after the property. It leaves the borrower a very safe sense of security because they know as long as they don't do anything wrong, as long as they don't do anything fraudulent or negligent, no matter what happens to the deal, the lender can only go after the property. Contrast that with a recourse loan, where the lender knows that they can always go after the borrower no matter what happens to the property. So that is the big difference. And it's important to understand because in dealing with commercial properties, they're almost always non-recourse. Construction properties, fix to flip properties, or significant rehab properties are going to have some kind of recourse to them. Often it's called partial recourse, perhaps full recourse. And that's simply because the underlying value of the loan is not substantiated by the property until the renovations are completed. So until then, they want to be able to go after the borrower as well as the property. And very often, as the properties are improved and more money is spent and the asset value is going up, they fix the bathrooms, they fix the kitchens, they fix the roof, whatever they do, at each stage in the construction or the rehab, the value of the property is going off. They may be something called the recourse is burning off, and that's the typical term that we'll use. The recourse burned off. Um, so that's important to understand. Just the fact that most commercial deals are non-recourse, and that's a big difference in terms of residential versus versus commercial properties, and it has an impact on the way lenders will look at the loan. If they know they can only go after, they're going to take a much deeper dive into the property itself. They're going to look at how the property was constructed. They're going to look at how they're going to look at the market where that property is located. They're going to look at the underlying financials of that property in much more detail than they would in a residential property. Why? Because they know that their only recourse is to go after the property. Contrast that to residential properties where they know they can go after the borrower. They're going to take a much deeper dive into the borrower and have much less interest in the property. Of course, in both situations, they want to know about the borrower and they want to know about the property, but there'll be a different emphasis depending on the type of recourse, non-recourse, or recourse involved on the properties. Next, debt service coverage ratio. So this is really a type of loan. We always think of this as a type of loan. In my experience, I don't think of it as a type of loan as much as I do think of it as a measure of how the lenders will evaluate the commercial loan that they're looking at. So this is a slight difference in understanding. From my experience being in the residential world, very often we think of a debt service coverage ratio loan, like that's the type of loan. I think in commercial real estate, you might find some lenders not calling it a DSCR loan. They'll just call it a commercial real estate loan. It is very similar or runs the same as a DSCR loan, but they might call it in general just a commercial real estate loan. What is the debt service coverage ratio and why do lenders care about it? Really, it's a measure of how well or how much the income coming off of a property can pay the debt. It's that simple. It's a measure of how much cushion there is over and above the debt, over and above the income to pay the debt. So a 1.0 debt service coverage ratio means that there's exactly enough money coming from the property to pay the mortgage payment. If you get above a 1.0, so a 1.1, 1.15, 1.20 and above, it means that there's extra money, there's a surplus, there's profit after the property pays the mortgage. There'll be something left over to go to the equity investors or the borrower themselves. So it's a measure of how much cushion there is between the income coming off the property and the mortgage payment. So in this example that I'm showing down below, we're looking at a property that generates $10,000 a year, or it could be a month, but let's look at it annually. $10,000 a year in income, and the property has a debt service coverage ratio of a 1.0. That means it makes exactly enough money to pay the mortgage. The investors behind it, the borrower and any investors that came in with him on the opportunity would make no money. Everything would go to pay the mortgage. A 1.1 means there's roughly 10% additional cash flow, additional profit above the mortgage. And a 1.20 or a 20% cushion, or 20% mean there's an additional zero point 0.2 or 20% coverage above the mortgage payment. It could go up from there. So it's really a comfort level for the lenders, and you can imagine why most lenders want to know that the property is going to make more than just the bare minimum to pay their mortgage payment. Because the lenders know that it's important that the borrower makes money. If the borrower doesn't make money, they're going to lose interest in this property. Why would they keep spending their time and their effort and taking the risk of owning a piece of property if they're not making any money from it? So that's why debt service ratio, the DSCR ratio, can become so important. The cap rate. So the capitalization rate is probably the most common term that people use to evaluate different investment opportunities in commercial real estate. It's really nothing more than a measure or a ratio between the income coming off the property and the current market value. And very often the current market value is just the purchase price. If you're paying, $100,000 or $10 million for a piece of property, that is the current market value. That's what you, as part of the market, are willing to pay for the property. So a cap rate can be thought of as the borrower's rate of return, their investment return, with no debt in the property. If they didn't take any debt, if they paid all cash for this property, how much money would they make? Simply, it's the cap rate. It's the income coming off the property minus what they're paying for the property. A lower cap rate means there's less risk involved because and a higher cap rate means that there's more risk involved. We call that an inverse relationship. Cap rate goes down, property value goes up. Cap rate goes up, property value goes down. It's an inverse relationship. But the cap rate in and of itself is only useful as a means of comparative. So it has nothing to mean. A cap rate of 5% in Charlotte, North Carolina, and a cap rate of 10% in, Kansas City, they're only relative to the local markets and their local type of asset. It has no other meaning that you need to worry about. So just be concerned within your local area, what's the cap rates on B-class multifamily property or A-class commercial property? That's what you need to be aware of. That's the lingo that you'll hear realtors and investors talk about, that they're expecting to pay a 7.5% cap rate on a multifamily property in Charlotte, North Carolina, for example. That same investor might expect to pay a 5% cap rate on a multifamily property in Manhattan, New York. Just depending on where that property is located, there's going to be a different risk-reward expectation, and there's going to be a different valuation put on those properties because the markets themselves have different risks and opportunities involved. So if you look at the example down at the bottom with some of these numbers, you can see the effect of how a cap rate can change valuation. So in this example, a $10,000 net operating income at a 6% cap rate would mean that that property is worth roughly $167,000. Nobody changed anything. All that happened was the cap rate changed, meaning the property still generated the same amount of money. All of a sudden, if you had a 9% cap rate, that property is only worth $111,000. So there can be a significant difference in valuations just based off cap rates. And how does this come into play? Well, let's imagine for a moment that you bought a piece of property and it had this. It had a $10,000 income. And before you were to change anything, something happened in the capital market, something happened in the economy, and cap rates changed. They went from 5% to 6 or 7%. Well, all of a sudden, your property dropped in value. You didn't do anything wrong. It wasn't your fault at all, but the capital markets changed, the interest rates changed, and now your property's worth a different amount. This has been happening. We're sitting here in 2023, just about 2024, when I'm recording this video. For the past 20 years, we've been in a very odd environment where interest rates have typically been falling and kept low artificially by the government and the Federal Reserve policy. That has made a lot of people tremendously wealthy in real estate because they bought properties at a 5% and the cap rates dropped to 4%. Nobody did anything, but the cap rate dropping increased the value of the property. So that's one situation where cap rates can have a dramatic impact on an environment. And different types of properties have different cap rates. Why? Because different types of properties have a different risk profile. For example, multifamily is often thought of as the lowest risk type of property in many markets. So often cap rates on A-class multifamily, where there's nothing to renovate, there's nothing to fix up, it's just a stable, high-class, relatively brand new property, that's going to be a very low cap rate in most typical markets. The other end of the spectrum would be hotels. Hotels typically have a higher risk premium to them. Think about it like this. On a multifamily property, that tenant probably has a 1 to 2 year lease. They're locked in for 1 or 2 years. That tenant is going to do everything they can to stay in their home. It's your home. You're not going to want to be in the street. You're not going to move your family out of that particular housing community very easily. You'll do everything you can. You'll change your car. You'll take a second job. You'll do everything you can to stay in that property. And that's why investors often realize that multifamily property has a lower risk. Hotels, on the other hand, you have to find a new tenant every night. If you have a 100-room hotel or a 300-room hotel, every single night you have to find a new tenant for your entire property. That's I'd say, much higher risk type of deal, and that's reflected in the cap rate. And then you can see down here when we're looking at this table, I'm looking at multifamily A class as the first property on the left, office A class, multifamily B, triple net lease or industrial properties, office B, retail, and hotels. This is a rough approximation. This will vary from time to time. It will vary in different markets. And that's just the important things to know. It has no inherent meaning other than in this particular market, Charlotte, North Carolina, these are the cap rates across different property types. It could be very different in other parts of the country. Let's look how cap rate can really help you create value, or how it can help investors create value. So in the deal that we're looking at, it's a fixed to flip property. It has X number of units. After renovation, the borrower believes that he's going to be able to raise the rents $100 per unit. So let's just look. In my top line, I have the number of units in the property. Let's take a look at a single family residence, 1 unit. I make my improvements, I can raise my rent $100. Therefore, the total amount I was able to raise my rent each month is $100 times 12 to annualize it. I have a $1,200 gain over the course of the year. But wait, I have to pay expenses on that. So without looking at a detailed spreadsheet, let's just assume that I paid 30% in expenses. I was able to keep 70% of the money. So out of my $1,200 additional revenue that I made from my rental activity, for my improvements, I'm able to keep roughly $840. This property has a 7% cap rate. That means I increased the value of the property $12,000. That's very nice. Look what happens though if I do that same program, but I had a 6-unit property. All of a sudden that same type of work gets multiplied 6 times. Look what happens as I go up to larger properties. There's a tremendous value creation from the same program. I come into a property and I think, oh, this property needs a renovation to its units, to its kitchens or to its baths. And you know what? That's going to cost me a certain amount of money per unit, but I think I can raise my rent $100. Now I can multiply that by 30, 40, 50, whatever the number is. I can create tremendous value in a property just by the cap rate. And as those cap rates go up or down, these figures would move up or down. So this is when somebody looks at a fixed to flip property, or they tell you they want to buy a multifamily property and they have a program of how they're going to increase the rents. This is how they plan to create value. So we looked at recourse, we looked at DSCR, or debt service coverage ratio, and we looked at cap rates. Thank you for watching. In the next video, we'll take a deep dive into financial analysis of a property.